Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. In today's video, I'm going to talk about risk and reward. And I'm essentially going to ask you the question, how much risk are you willing to take for the reward? And then the other question is, can you always recognize risk? And sometimes can risk actually become opportunity? And we're going to do that by a deep dive analysis of the company Comcast, symbol CMST. We're going to look at it from a fundamental perspective. We're going to talk about what's going on inside the company. We're going to try to hypothesize why the price might be so low and whether there is a long-term opportunity or not. So let's go ahead and get into the FastGraphs Fundamental Analyzer software tool, the value investor's best friend. And by the way, as I go through this, if you don't subscribe to FastGraphs and you have stocks in your portfolio, you're making a mistake. You need to take a hard look at FastGraph. We offer a free trial. We'd love you to take a look at us. So anyway, let's go into the FastGraph tool now and look at Comcast. All right, so what we see here by simply looking at the FastGraph, and for those of you who aren't familiar with FastGraphs, let me introduce some things. I'm going to take some stuff off of the graph so you can understand what you're looking at. The orange line is a plotting of the company's earnings per share multiplied by the growth rate over the time frame I'm measuring. So during this time, I'm using a PE ratio of 20. Okay, and when I put weekly closing stock prices on the graph, you can see that there was a period of overvaluation where the PE of Comcast back in 2005, all the way through the Great Recession, where the PE finally got down to about a 15 multiple. And I'm going to talk about that a lot more here in a moment. This is a clear case of overvaluation and how dangerous overvaluation is in the long run. Here's a case where you'd have lost a lot of money, even though fundamentals of the company were growing unbelievably well at that point in time. Okay, but we're using a 20 multiple. But watch what happens to that 20 multiple. Watch what happens to the valuation of this orange line when I change time frames. When I drop it down to a 14-year graph starting in 2014, now we're valuing the company at a 15 multiple. And this is utilizing a discounted cash flow analysis of what the valuation should be. Now, when I put price on the graph at this level, we once again see a time frame where the normal PE, the average PE that the market was applying, was higher, was about 16. But that's a mixture of being overvalued here, where the PEs were in the 20 range, and being fairly valued here and then undervalued here. Okay, so I want to make that clear. So obviously Comcast growth has slowed down. Now, if I drop this to a 7-year, which actually includes approximately 4 years of history, actually 4 3/4 years of history, plus 2 1/4 years worth of forecast here, now we got growth rate down to 9%. Okay, and we have a normal valuation over this time frame of about 12 times earnings. But I think the fair value PE ratio is the one you really ought to be focusing on. So based on this metric, if we evaluated what is the fair value of Comcast today, FastGraphs is indicating 64. If we use the market average, it's about 52 for the last several years. Okay, now there are leading analysts talking about that. So here's the point. Let's look at the metrics here. First of all, it's trading at a PE of 7. That's roughly half, we'll call it. 7.38 is roughly half of the 15 PE, which would essentially be a fair value for a company growing at 9% a year. Okay, and I'm going to go back to the max level now. The company had a lot better growth than that, but we're going to drop it to 15 years and keep this 15 PE ratio in mind, because I think that's really the fair value of this company. Now, it's a dividend payer, and right now, if you bought it today at this low valuation with a 7.38 PE ratio, you'd get a dividend yield of 4.16 and an earnings yield of over 13%. That's more than double the 6.67% earnings yield, or roughly double the 6.67% earnings yield that I consider a minimum, which is a 15 PE. Now, let's look at the dividend safety a little bit, okay? Let's talk about operating cash flow covering the dividend. As you can see, and I'm going to take price and normal PE off here. I just want you to look at how much cash they got covering their dividend. And notice from a standpoint of cash flow, their payout ratio is 15 to 20%. So they still got a pile of cash flow here to be paying and covering their dividend. Now, free cash flow is even more important. And if we look at free cash flow coverage, we see the same thing. They've got enormous amount of free cash flow. They're paying out roughly around 30%, 29 to 30% of their free cash flow to dividends. Okay, so that's really an excellent coverage. So the company's dividend seems to be well covered. They've had 18 consecutive years of dividend increases, I might point out. And just looking at the data here, the dividend looks extremely safe. Let's put the price on the graph here. And you can see as a price to free cash flow, the stock looks very cheap. If I look at price to operating cash flow, the stock also looks very cheap. Okay, even below the normal discounted price to free cash flow that the company has been trading at for the last several years. If I look at EBITDA, which is a form of cash flow where we're eliminating interest, taxes, depreciation, and amortization, this is the cheapest it's sold. Actually, if I go back the whole 20 years, this is the lowest valuation we've had. Here you're looking at, well, there's 3.05, and that's 3.16 is the current blended price to EBITDA that you're looking at. If you'd have bought it there, even at its low discounted price now, you'd have made over 11% a year. If you'd have bought it here when it was trading at that 3 cash flow area there's exactly what it's trading at now, and held it to where it's peaked, you would make over 19% a year. Now, let me say a couple of things about these valuations here. What I want you to note is that you're seeing an absolute proof by just simply looking at this graphic that the market misappraises the value of a stock. It was tremendously undervaluing it all through 2009, 10, 12, etc. Then it had a penchant to overvalue it through 2020, 2017, and of course into 2021. And then we've had this tremendous drop in value. Now, I like to value stocks using operating earnings for those of you who follow my work. But I'm going to drop this to a lower thing. I want to use the 15 PE ratio as fair value because I think that's a solid number. Now, if I look at forecasting right now, earnings growth is expected to be about 4.79%. And I do want you to note that the analysts have been lowering that from 6 months ago to current. The estimates have actually been dropping. They were expecting more than that. I'm going to talk in a minute about what management is forecasting if we go out to things like 2028. The average growth is supposed to be about 3% a year. And by 2028, analysts, that would indicate about $4.88. Guidance, the company's guiding for $4.65. Okay, so what I'm simply saying is earnings are expected to continue to grow. All right, so let's talk a little bit about what's wrong with this company. Now, here's the point I want to make before I do that. The price has been a lot higher with not necessarily any superior numbers. They've been somewhat superior, but we were valuing it at nosebleed valuations up through 2017. Then it was fair value for a while. Then COVID, it got undervalued. And then it was overvalued again. And now for almost 4 years, it's been trading at these extremely low valuations. Now, to be fair, if I drop this down, growth has still averaged about 5.5%. Forecasted growth is only supposed to be about 4.79%. If I look at revenues, which is very important, revenues are only expected to grow by about 2%. And I'm going to talk more about how the revenue estimates are being factored in, and I'm going to get into some of the detail there. But let's talk about what's wrong with the company. Why is the market pricing very strong fundamentals? In other words, if we look at it from any metric you want to look at, Comcast PE ratio is currently 7, okay? And if you look at price to earnings, price to EBITDA, discounted cash flow analysis, all shows that this is a cheap stock. But what's happening is the company has been losing subscribers tremendously in their video and broadband subscribers, okay? They've also been losing TV customers at the rate of 225,000 per year and numbers like that. They've lost over 25 million subscribers in recent years. So that part of their business, their traditional media networks, face declining viewership and obviously dropping advertising revenue as consumers nowadays are shifting to streaming. Now, their Peacock streaming service is growing at 18% a year in the second quarter of 2025, but it does face stiff competition, so there's some risk there. Now, broadband market situation is a problem. The rise of fiber and 5G home internet has eroded their dominance for clear. Fiber now accounts for 34%, almost 33% of the cord cutter internet usage, and 5G for about 16%, both up sharply. Now, broader market and macroeconomic factors are also affecting the company. Inflation and consumer sensitivity has been a big issue. Okay, so high inflation has made consumers more price sensitive, and telcos have struggled to pass on cost increases to their customers. Now, interest rates and capital costs are also another headwind. Rising interest rates have increased the cost of capital, impacting all highly leveraged companies, including Comcast. And as you can see, they have 48.3% debt to capital, okay, which is reasonably high, but not excessively high. In fact, their very powerful cash flow generation, which is continuing, is expected to easily handle that and cover that. Okay, they've got interest coverage is very high for this company. Okay, now they also have some litigation and regulatory risk. They had a litigation from a data breach that affected over 35 million customers. And they've also got federal investigations into DEI practices and persistent regulatory scrutiny all along. The company does have a high debt load, and that comes from a bunch of acquisitions that they made in their legacy business. Now, let's talk about the valuation a minute from a standpoint of view of market irrationality. Okay, I believe the market's overreacting, because even with this type of growth, we ought to be seeing higher multiples on the stock. And remember, there was a time when the market put higher multiples on the stock. Okay, so one of the things that the market seems to be ignoring here, and keep in mind, we've got a high dividend yield of 4.16%, a dividend that has grown dramatically by over 6% a year, actually for the last 14 years, almost 15% a year. And you can see that the dividend has grown, as I said earlier, for 18 consecutive years. Okay, so their dividend is a very interesting part of why investors might want to consider this company right now. And the safety of the dividend, I think, is very well defined at this point. Okay, so there's several sources out there that are forecasting fair value of somewhere between $50 and even up to as high as $80 a share. So if I shorten the time frame to be conservative and look at a conservative where we only put an 11 multiple in the stock, that would indicate a $48 fair value, and the stock's currently trading at 31. Okay, the fair value would be over 64. Now, if we looked at places like Morningstar and went into Morningstar to see what they had to say, Morningstar gives Comcast 5 stars. They say their fair value is $49 a share, and the current price is 31. Now let's talk about how Morningstar comes up with that number. So let's scroll down here into the Morningstar report and look at their fair value estimate. Okay, their fair value estimate implies an enterprise value of 7.7 times our 2025 EBITDA estimate. Okay, so let's go to EBITDA. Let's go into fast graphs and let's look at EBITDA. Okay, and this is 5.63. If I go into forecasting, they're looking at 7 times EBITDA as a fair value, and that, based on FastGraphs numbers, would put the fair value at around 73. Okay, if it was 7 under the current number, it would be about 72. Okay, so Morningstar is coming up with a lower, obviously, EBITDA estimate, but they do yet consider the stock very undervalued. All right, I just want to make that point. So let's talk about valuation and what's going on with the company. Okay, so let's talk about their growth thesis. With losing all these subscribers to their legacy products, why are analysts forecasting growth? Now, part of it comes from the fact that the company's guiding them to growth. Okay, so let's talk about what they're doing. There's wireless expansion. Their Infinity Mobile is now 14% penetrated in their residential base, with bundled customers showing 80% higher lifetime value. Wireless is a major growth engine that's offsetting broadband losses. Not totally, but it's doing it. plus business services. The business segment is growing at mid-single digits with strategic acquisitions expected to accelerate growth. Now, there's some risk in that, obviously, if you think about it. But also we got theme parks and entertainment. The $7.7 billion Epic University theme park built in Orlando, Florida, is projected to generate $1.7 billion in annual revenue by 2026. And Peacock is growing rapidly with 18% year-over-year revenue growth. Their free cash flow for the last quarter remained very robust, supporting dividends and buybacks. Now, Comcast projects the company about $128.7 billion in revenue and $13.9 billion in earnings by 2028. I'll convert that to per share data here in a few moments. But this implies modest but steady growth. Okay, the dividend safety, as I pointed out, the dividend yield of over 4% is well above the S&P average. And they've had 18 consecutive years of increases, I pointed out earlier. And again, the dividend based on operating cash flows or even free cash flows is extremely well covered and safe. The free cash flow number of $435 is covering an expected dividend of $1.40 for 2026. And it's got a $443 covering $1.32 for this fiscal year, which ends obviously in December. Okay, so their operating cash flow for the last trailing 12 months has been over $31 billion. And again, free cash flow has been over $19 billion. The coverage, dividends are covered 6.5 times by free cash flow and over 10 times by operating cash flow. Okay, there's your free cash flow number, and here's your operating cash flow number. So the dividends is extremely well covered. That's the point I want to make here. And their cash payout ratio is very low, leaving ample room for increases. So low payout ratio, strong cash flow, and a long history of increases all point to what could be a high level of dividend safety. And even with the industry headwinds that I covered earlier, the dividend is extremely well supported and likely to continue growing. Now, one of the questions I asked myself as I was doing this research, is there anything missing beyond market irrationality? And I posited that while market sentiment and irrationality certainly play a role, but there are several real risks and headwinds that justify some discount, though likely not to the extreme that the market is currently discounting the price. When people see prices this low, they are much more likely to have a jaundiced view of a company because the price hasn't done well and not even focus or pay attention to the operating results, which have actually held up well and indicate a much higher valuation. Okay, so there is some structural industry decline, as I talked about. The core cable and broadband businesses are in a secular decline, and the market is skeptical that new growth engines, or seems to be skeptical that their new growth engines can fully offset this. There's also execution risk. Comcast has to successfully scale their wireless, streaming, and business services to replace the lost revenue and margin from the legacy businesses. And then they got those pesky lawsuits I talked about earlier. But their streaming service, Peacock, is growing, as I said, 18% a year. But streaming is actually a low-margin, high-competitive business. And it's not yet clear, at least to me and other analysts, whether it's going to be a major profit driver or not. Consumer belt tightening from inflation and economic slowdowns could further pressure subscriber numbers and annual revenue per unit. But I see those things improving in the near future. So in conclusion, Comcast is trading at a deep discount to fair value with robust fundamentals, strong cash flows, and a safe and growing dividend. The market appears to be pricing in a worst-case scenario for the legacy broadband business and is skeptical, apparently, about the company's ability to offset these declines with new growth engines. While there are some real risks, cord cutting, streaming competition, broadband saturation, litigation, and debt, the current valuation, in my mind, appears excessively pessimistic. If Comcast continues to execute on its growth initiatives in wireless, business services, streaming, and theme parks, and manages its risk prudently, and as indications it is, there is substantial upside potential in the company. I mean, even at these low valuations, we could be looking at rates of return that are really staggering for the company. looking at the normal estimate going out to 2028, we could see annualized rates of return of 46%. It may not happen immediately, but the longer we look out here, the more likely it is to happen. Even at a low multiple of only 12 times earnings, we could still have over 36% annualized rates of return based on earnings. Okay, so the dividend is well covered and safe and likely to keep growing. And the dividend and the income, if you're an income investor looking for income, makes this a very attractive company for you to look at, in my opinion, because you've got a safe and growing dividend that you can buy for a song in today's prices. Okay, it's likely well covered, and it really seems like it has a great opportunity to continue growing, making it both value and income investors happy, in my opinion. All right, so in summary, the low price is driven by a combination of industry headwinds, macroeconomic uncertainty, and market skepticism. But the fundamentals, and fundamentals matter and matter a lot, as I always say, suggest a significant mispricing that could correct, and I'm not guaranteeing that, but it could correct as long as they continue to grow those fundamentals as they demonstrate resilience and growth in their business. So if we look at some of the metrics I mentioned in gross numbers, let's start by looking at revenue. Okay, the revenue numbers I gave you would indicate that by 2028, and let's go ahead and I'm going to use the historical growth because it goes out to 2028. The revenue numbers, projected 2028 revenue would be over $40 per share. And that's also the consensus of the analysts that are following it. There's actually no analyst reporting, but $40 a share is what the growth would indicate. Projected 2028 earnings per share, looking at adjusted operating earnings per share, at the growth rate of 6.67%, which is a long-term forecast, would be about $5.61. On the low side, I think you could look at that at around $4.65, which I think is a little better number. And these are based on analyst forecasts and also reductions in share count. So let's go into fiscal fitness real quick, and let's look at that. Share buybacks, while this stock has been cheap, something that I really like, as you can see over the last 8 years or so, they've been reducing their share count at the rate of about 2.7%. For the last 6 years, it's about 2.8%. And they reduced it quite a bit in 2024. Okay, so the share buybacks are going to help contribute to this earnings growth that I'm talking about. So while we're here, let's talk about revenue. Revenue is actually held up and is expected to grow around 2 or 3% a year going forward. Their net income has been growing. There was a weakness in 2022, which is COVID. By the way, also their operating cash flow is way above net income, as I've already pointed out. Let's look at margins for the company. Margins are actually holding up pretty well. Now, margins increased dramatically in 2011, and they've really held up pretty well since, and that's their growth margin. Their operating margin has actually been slightly improving since COVID over the last 4 or 5 years, maybe had a little drop off in 2024, and likewise their net margins are holding up. So the company's got a lot of things going on. Now, analysts expect share count to be dropping by about 3.5% per year going forward, and they estimate the 2028 share count to be around 3.2 billion shares after buybacks. So that's where some of these numbers really come. That's where the $40 and the numbers that I talked about earlier look at. So the bottom line is this company is really an interesting stock. So let's take another look and take another deep dive into the company. Now, cable communications, which is Xfinity for them, includes broadband internet, video, cable TV, voice, and business services. And currently, its share of revenues, well, let's go ahead and look at revenues. Its share of revenues or sales is 54%. Now, this is still their largest segment, though it's the one that's been shrinking due to the cord cutting and increased competition in broadband that I referenced earlier. Okay, it includes both residential and business customers. NBC Universal encompasses media like NBC, Telemundo, cable networks, filmed entertainment, which is Universal Pictures, and theme parks, Universal Studios. Their revenue share is about 34%. Media is 18%. Filmed entertainment is about 7%. And theme parks are only about 9%. Okay, Sky, which is European pay TV, broadband, and content, revenue share is about 11%. And so corporate and other, including Peacock and wireless, are really quite low at this point, but growing, at least the Peacock is. While still a small percentage of their revenue, these segments, as I mentioned, are growing very fast, and Peacock and wireless are expected to become more significant over the next several years. But that might take a few years for that to happen. Okay, but I'm going to argue that that's already priced in at these very low prices. So I think the risks that I've been describing here are already priced in by the market. The market is very pessimistic here. Okay, so I think even though they've lost 2 million cable TV subscribers here just since 2022, they've got growth in all these other factors going on, which means that the company is not going to be a rapid grower for the next 4 or 5 years. But they are repivoting and repositioning themselves, and they are expected to have some growth. And even at that level of growth, this price is absolutely ridiculously low. So is that risk, or is the risk already wrung out of the company? That's the question. Based on what we see going forward and what I see going forward, even with only a modest growth going forward, I'm looking at the ability to get back to a 15 PE, or certainly an 11 or 12 PE is certainly not unrealistic. And again, that can generate some unbelievable rates of return. But the problem is I don't know when that could happen and how soon market sentiment can change. And that's a major point here. This is all about market sentiment. Okay? So the real key here is that if market sentiment changes, then you could see a rapid increase in the valuation that the market is applying to the company that is actually more reflective of what the company's fundamentals actually show. So to reiterate, the growth drivers are business services. They're expected to maintain mid and single-digit revenue growth, which is a stable and profitable counterbalance to the declines in their residential declines. Streaming Peacock had 41 million subscribers by the second quarter of 2025, and their revenue grew by 18%, reaching $1.2 billion. So again, it's minimal compared to what the company's totals are, as I pointed out earlier, but still very good. And ultimately, Peacock, the company is positioning them as a core asset, leveraging their broadcast and sports stations. Theme parks, Epic Universal, again, is the first major U.S. theme park in over 20 years and expected to add a significant revenue. So the bottom line is the company's not going out of business. Okay, the theme park grew 19% in 2025 with over $2.35 billion for the quarter. Theme parks are expected to be a major contributor to Comcast growth and diversification, with new developments planned in the coming future. And again, there's some risk in that. They also have digital equity and community investment. Programs like Comcast Rise and Projected UP support small businesses and digital inclusion, enhancing Comcast's brand and future worldwide pipeline. So analysts and industry outlook, revenue growth, despite the decline in cable communications, analysts still project about 2 to 3% revenue growth from 25 to 27. And that's exactly what we're showing here on FastGraph, just about 2% growth, up to 3% in some areas. So the stock is rated a moderate buy by several analysts on Wall Street with an average 12-month price target of 40. That would put it on a price-to-sales basis. That would put it at about, we'll call it around 1.2 to 1.3 times sales, which would be still a very modest multiple of sales for the company. So in summary, while the decline in communications is steep and ongoing, it looks to me like Comcast's diversified growth strategy, centered on wireless, business services, streaming, and experiential entertainment like theme parks, is expected to more than offset these losses and support continued growth in the years ahead. Now, how fast can that happen? As I mentioned, it's liable to take several years, potentially even into the late 2020s. But I think the real key is the only way I believe you can truly expect to lose money in this company is if the fundamentals fell off a cliff and deteriorated. They're not expected to grow very fast, but they are expected to flatline grow going forward. And that's almost all aspects of the company. Now, if those expectations come to fruition, then this is an extremely undervalued stock, and it's worth taking a look at, especially if you're an income investor, because obviously if you invest in this stock for the income and look at the dividend and the dividend growing, you can patiently wait for that to happen. But I'm going to conclude this by saying this. People will ignore the orange line on the graph that I'm showing you here. That's the real value of the business. Like it or not, that's the real true intrinsic value, fair value of the business based on the ability to generate strong cash flows and earnings. Okay, the price is often misappraised, and I showed you that by looking at the max. There were times when the market was overvaluing this at crazy levels, and those were horrible times to be an investor in the stock, even though the business was doing quite well during that time. That meant no money or dead money for several years. Then the market was pricing it at 20 multiples for several years, and now all of a sudden we're pricing it at single-digit multiples. That, to me, is an opportunity for an extremely powerful company with a market cap of over $117 billion. They do have some debt, but they've been amortizing that debt, and they've been handling it very well. And I think you're going to continue to see buybacks at these low valuations, which is going to help earnings. And I think you're going to continue to see dividends and dividend increases. So all in all, for those of you who are looking for income, I'd take a deeper look into Comcast. Anyway, this has been Chuck Carnevale, co-founder of FastGraphs. I hope you enjoyed this analysis of this company. To me, this is a classic case of the market misappraising a stock. The company does have problems. That's undeniable. But those problems are way priced in. So from a risk-reward standpoint, I think the long-term risk here is extremely low and the potential long-term returns potentially extremely high. Now, that could change if the fundamentals do deteriorate rather than modestly growing, as I pointed out here. But that's something, as an investor, if you invested in the company, you'd want to watch very closely. So far, it looks like Comcast is on track to deliver the results that management is guiding to and that analysts expect. Anyway, I hope you enjoyed this video. If you did, subscribe to a channel, ring the bell, give me a like, take a look at buying FastGraphs and all that good stuff. And we'll be talking to you again very soon. Thanks for watching.